Welcome to another monthly edition of the Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Scene change here. Moved office from downtown Fort Worth to North Fort Worth, almost up in Keller. So a little different background for you. And those of you who were less than thrilled about going downtown and parking in one-way streets, here you go. So let's get started. Great March, another great month. 3.3% return on equities, the S&P 500. That puts us at 10% for the year. And that extends our tremendous run to 5 months. And so what's driving that? Well, strong earnings is the primary thing that's been driving that. Now we've seen inflation worries easing. We're still looking to the Fed for rate cuts, but really the S&P 500 forward 12-month earnings is up 3% last quarter. And, that's a lot. And it's a huge reason for why stocks have been strong. Not necessarily because of the Fed or M2 money supply or some magic button that the U.S. Treasury has been pushing. You've heard me say this 1,000 times, but profits drive markets. Now, you're beginning to hear several things. After a run like this, it's natural, but you're beginning to hear several things. You're hearing, this can't keep happening. What goes up must come down. Here comes the plunge. We're due, we're overdue. Okay. A couple of things, though, that you're not going to hear, which is why we're here. We call this the antidote to the water cooler wisdom. Some things you're not going to hear. The first is, what's normal? Those of you who've been watching these videos or clients of mine for 15 plus years, you know what I'm about to say. Volatility is normal. And so the insinuation that there's about to be a drop or 5% or a 10% correction, there's supposed to be volatility. 4, 1, and 1 in 4. Those numbers, you've heard me echo these. 4 times a year, we're supposed to see, on average, we're supposed to see a 5% pullback. And once a year, you're supposed to feel a 10% correction. And 1 out of every 4 years, we have a bear market, which is 20% or more. But volatility is normal. There's about to be a pullback, a drop. It can't, there's supposed to be. 4 times a year, a 5% pullback. Once a year, a 10% correction. And we're getting to levels here where 10% is serious, okay? 10% on a 40,000 Dow Jones is 4,000 points. 4,000 points. That's not nothing, but it is normal. Volatility is normal. It comes with the territory. That's the first thing you're not going to hear right now from the traditional media sources, your email inbox. The second thing you're not going to hear is what history has to say about strong runs like we have seen. The S&P is poised for, we've just seen its 5th. This would be, we're on our way to maybe 6, potentially 6. But 5 straight monthly gains, November through March. That's only happened once this decade, and that was 2013. According to the Stock Traders Almanac, when the S&P 500 has accomplished this feat since 1950, the benchmark index, the S&P 500, has risen during the remainder of the 9 months, all 11 times that we've seen this, with an average return of 12%. Now, this stat joins several other stats pointing toward gains for the rest of the year, including the stock market's strong track record during second year bull markets, okay, the second year of a bull market, and market performance that follows new record highs. And while further gains from the broader equity markets this year may be tough based on the fact that we have come so far in such a short amount of time, the technical analysis is not suggesting a risk-off, a nervous, a conservative stance or rebalance. And history tells us that strong momentum can continue longer than we may even expect. The duration of the late 90s bull market serves as a great example, with the internet build out rhyming very similarly with what we have going on today, a burgeoning AI wave, artificial intelligence wave. One other point, if 10% quarter one was rare, let's talk about back-to-back double-digit quarters. Because we had a double-digit fourth quarter, and then we've had a first quarter. This is only the 8th time ever that we've seen that. And when that occurs historically, 1 year later, stocks were higher 6 out of the 7 times that that's occurred. And again, the average was a 12% growth. So you'll hear a lot of things after a solid run like that we've seen over the last 6 months. But there are a couple of tidbits to help you fight maybe that prevailing internet wisdom. Well, spring is here. The Masters is on the way. The weather's been gorgeous. I hope you have a great April, and we will see you next month in May.